Hello, 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 everyone, and happy Monday. Welcome again to Engineering Growth. This is a podcast we do every Monday morning. We've been doing it for the past 6 months. You've seen our face, and we're sharing the things that I think you need to that would help you in your business, right? It applies to a whole lot of businesses, not any particular industry or sector, but anybody who's really trying to understand how to grow and scale their business from a capital perspective. My co-host is not with me today, Charlene. She's got a bit of a migraine, so we're just going to truck on through and show her what we did after the fact. So as we get started, the topic I wanted to talk about today, first Monday of March, as we get into the end of the first quarter, which is the quarter that really defines the year. This is the quarter that really says, okay, this is where I'm going to stack my most wins and try to get the most done, because then we start getting into summer and travel and vacations and then holidays later on. So this is really your most ambitious quarter, kind of depending on the industry you're in, right? If you're in taxes, insurance, like you have other quarters to pay attention to. But let's look at why 7 out of 10 profitable businesses still get denied funding. That's the topic I chose today. And I chose that topic because I wanted to really make sure that everybody from today understood that profit does not equal predictability. Okay, that's the core understanding today. There are several reasons why profitable businesses still get denied funding, right? And starting with, when you look at the reason, when you go to a lender and you try to pursue a loan or any sort of capital, lenders are by their very nature risk averse, right? Think about it. You have these people with hundreds of thousands and millions of dollars that you're saying, hey, give me that money for my business, right? Even if you have a relationship with them, most of the times it's like they're seeing hundreds and sometimes thousands of people in a year asking for money, their money that they have to give to you, right? On the back of an idea, on the back of a plan, largely on the back of maybe this person has an ambition of what they want to achieve, but they still have to figure out, okay, if it's a traditional lender, how do I take somebody else's money, give it to this person, and make sure I get it back? If it's somebody who's like an investor, how do I take my money and give it to this person and make sure I get it back? And the thing that they analyze first and foremost is the risk. What is the risk? And as someone myself who's seen hundreds and hundreds and hundreds of business plans and ideas, I had one guy who raised or came to me to raise $500 million to build a stadium in California. The guy had never built a stadium, had never done sports, like had no connection to the project whatsoever. But this grand plan with the mayor who was on board and like the revenue streams was going to make this great. And ultimately, at the end of the day, it was risky. It was massively risky. And so the thing that we have to look at when we're approaching a lender is we can't come from I have this great big vision, and I tell this to my clients all the time. You may have the best plan in the world, but you have to also understand from a lender's perspective, I'm seeing 50 other people with that amazing plan, with who think that their plan is the best. And my no to you doesn't question your plan. It just says, maybe I can do somebody else's plan with a bigger return and less risk, right? It's an evaluation of all the plans in front of me, not just your plan. So when you come in with your plan of how you want to use this capital, you have to understand it from a lender's perspective. Is it risk? Is it something where the risk is fairly reduced and the ROI is great? Or is it really risky? And here's some of the things that make things risky, right? No experience, no skin in the game from the person who's doing this, putting it together. Really, no background in the industry or the space. Really ambitious numbers. So the ROI is like ridiculous. Doesn't matter if you're a lone ranger in that particular space. People aren't competing with, when people are spending money, they're not just spending money on your industry. They're spending money in a whole bunch of other things, right? So really aggressive numbers, they don't work. And then sometimes, like, understanding the background and the history and the experience of the person. This doesn't mean your industry, but if you are somebody who's failed several times in business and you're coming to ask for an exorbitant amount of money for another business project, it's going to give the lender pause, right? Your own background, your own personal financial statement, like those things are all risky things if you don't have a good track record. Now, there are ways to overcome all of those 5 things, sometimes with a business partner, sometimes with, a strategic partner. There are ways to mitigate those risks. But to just come in and say, I'm an inexperienced kid out of high school who's just generating, who has like plans to generate $100 million in the next 5 years, doing this really great invention, and I need you to give me money. You're not going to get the money, right? And you have to be realistic and not ambitious. Number two, profit on a P&L means absolutely nothing if you don't have clean and consistent tax returns, if you don't have consistent deposits, if your debt service coverage is out of whack, and if you don't have a property entity structure. Okay, so I was doing a loan for a guy the other day, and thankfully for him, like we were able to get this done and get it done creatively. But he came to me, he's like, listen, I have a rental property. Rental property was in his name, not in an LLC. First of all, for your own liability, especially for rental properties, if somebody slips and falls, if something falls on them, if anything breaks, like you want to make sure that that is protected in an LLC. Otherwise, all your assets are at risk. Your house, your car, everything's at risk if something happens to your rental property because it's not an LLC. So he lacked the proper entity structure, but we were still able to work around it. Debt service coverage ratio. Another client that I have, we're trying to refinance some of his office complex, and sadly, the thing that kept coming up with lenders is his debt service coverage ratio was just not there. Right? He calculated it at one number, they're calculating at another number, and the reality is like if they don't get the number they want, then you don't have enough liquidity to cover the debt. Right? And debt service coverage ratio, for those of you who don't know, is if you have $100 in debt, we need you to have at least $125,000 in revenue so that we know that you can cover your debt and still have a little bit of spread. Okay. And if you have 110, that's below the debt service ratio. So when a lender says, hey, our minimum is 125 to be able to give you a loan, and you're coming in at 110, I don't care if you're profitable. I don't care if your P&L shows that you're driving revenue. You're not going to get that loan because of that service coverage ratio. Consistent deposits. If you have a deposit in January for $100,000 and your next deposit's in June for $100,000, a lender again is going to have pause because you might be making a profit. But what if that next June deposit doesn't come through, right? Your business is reliant on these sporadic, or what we call seasonal deposits, and seasonal deposits don't drive consistency and don't mitigate risk for a business, because if one gets missed, that's a massive chunk of your revenue. So this is where consistent recurring revenue makes a big difference. And a lot of businesses say, well, I'm a landscaping company, or, I do seasonal rentals. Guess what? There are ways. I work with companies, like people who are buying snow removal companies or landscaping companies. Guess what? If you're a landscaping company in the summer and winter you don't make any money because you're in the Northeast, then find a way to turn your landscaping company in the summer to something in the winter. You can do a subscription service to check on people's pipes and make sure they're winterized. You can start doing snow removal with the same crews that you have, even if it's just shovels and not actual trucks. You can start doing again another a repetitive service where you do tree lighting, for example, using the same crews that you have. But find a way to make your business all year round, not just for the sake of getting capital, but passing it on. People want to see a year-round business that's making money when they buy it, and they don't have to figure out how to fix the winter months, because the summer months are the most profitable. And that way you get year-round revenue. And then clean tax returns. Right? Making sure, again, if your entity is properly structured and it's an entity unto itself, you're not having mixed funds. Right? One of the things that I find most common right now, as we do a lot of acquisitions, people are doing tons of acquisitions now, is as you acquire a business, we're having a lot of what we call adbacks, right? So the business makes about 300,000 in EBITDA. Well, that 300,000 in EBITDA does includes the owner's personal car and their insurance and some meals and transportation, and all of these adbacks then now need to be put back in to that 300,000 EBITDA to get the true EBITDA of the business, if that owner didn't use the business and layer in a bunch of expenses. You want to know that you start with the end in mind as you go into business today, as you look at your business today, whether you want to sell in 3 years, 5 years, 10 years, you're going to have to make sure that your business is clearly separated from your personal expenses. and those add backs don't overwhelm the EBITDA line. Because I will tell you, doing a lot of SBA financing myself, SBA doesn't like to see a ton of add backs. The second you go over a certain amount of add backs, it becomes like, okay, hang on, this is way too confusing, and I don't know if we want to get involved in this business or do that, because we don't know the true value of the business with all of these different add backs. I actually have a client right now who's taken his business off the market for a year so he can clean up his financials and then bring it back on to sell because he had a number of add backs. So you want to make sure that's not you. You want to make sure that your tax returns are clean, that they are well documented, and that your P&Ls can really stand on their own. So the third item is what I just mentioned. It's a lot of founders just write off too much as well, right? So their fundable income shrinks, and when it becomes time to sell the business or pass it on or get capital, there's this, oh, but I made a ton of money, but you wrote off a lot of stuff. And we're taught this, we're taught this concept of bring your profitability down so you don't pay as much taxes. And then you start writing a whole bunch of stuff off. But guess what? When you do that, the counter argument is when you want to grow and scale and expand, you've shrunk your profitability. So on the tax side, you may have paid a little bit of taxes, but now on the capital side, where we have to leverage your profitability for capital, there's not a lot there to go on because you just wrote off a bunch of stuff, right? And so sit with an accountant. Figure out exactly how to make sure that you're getting a balance of both. There are strategic tax structures and ways to make it so that you aren't hurting yourself in one area to build yourself up in another. Figure out what that write-off amount is and what the taxation looks like, and how do you adjust your fundable income. And then the last thing I would say is to make sure that you are fully bankable. Bankability is engineered 12 to 24 months before the actual application. It is making sure everything that I just told you is apparent in whatever your business is, that your tax returns are solid, that your P&Ls are sorted, that your write-offs are in order, that your entity's already been structured, and that you have a historical approach. Some loans that we do, whether it's a term loan, whether it's a working capital loan, they want to see 6 months of bank statements because they want to know you have consistently had deposits, you've consistently had profit, you aren't taking in seasonal income. They want to make sure that you have a consistent track record and your banking statements. So that 12 to 24 month period allows you to start structuring and making sure that you are putting things in place, you are structuring the business, you are making sure that your numbers are in order, so that when you do make that application, whether it's for 100,000 or 1 million, that everything is set in place, that everything is workable. So those are the 4 areas that really impact businesses when they think they're profitable, but they're still getting denied funding. Because at the end of the day, fundability is a long-term strategy. It's not an event, right? You don't just decide, okay, I'm just going to expand or buy a second business and do this one time. You have to make sure that you're constantly and consistently putting yourself in place for short-term, long-term, sporadic, and consistent capital. I hope this was helpful to folks, and I hope that you guys will continue to join us. You're going to see a little shift in how we do these, but the goal here is to make sure that we're giving you real strategic and impactful value, so you understand exactly how to pursue capital and how to manage and grow and scale your business. Now, we ourselves, we do this for a living, right? Everything that I taught you today, it's because I have clients that are going through it on a regular basis. I have clients that I sit with that we're working through all of these different things. And as I learn from them, I want to bring to you. And as I clear them up, I want to share with you as well these case studies so that you guys can see you're not alone. But if you work with us, you can get this done right. And we aren't accountants, or we're not CPAs, and we're not tax strategists. All we are capital providers. We can tell you, okay, you probably need to change these things. Go talk to your accountant before we can pursue capital for you. But what we do is we help you say you are bankable, you are investable. So at this point, we have a bunch of different options for you. We're going to go out, we're going to pursue those options, and then we're going to bring you back some results. And then you get to choose from those results. Okay, I want this funding, or I need this funding. Or we'll tell you probably need to get yourself in order before we can pursue funding for you. And that's our job. Our job is to do the capital side so you don't have to stress yourself out, and you can do what you do best, which is the business. So if you want to learn more, if you want to have a quick conversation with me, if you want to see where you are capital wise or what you're working on and you may need some help or you just need to understand something or see what your options are, it's no cost obligation, no obligation call that you get to have with me. Just visit oneglobalfinancing.com and we will be happy to jump on a call and talk it through with you. Otherwise, have an amazing rest of your Monday and rest of your week. And we will see you right here again next week, Monday.